Canadians, as of April 2023, you have the ability to open a new savings account to help build a down payment for your first house. This is in addition to the RRSP and TFSA. It's called the FHSA, the First Home Savings Account, and it's actually a mix of the first two I mentioned. This video will be breaking down everything you need to know about the FHSA. I was going to make a pros and cons video, but I'm having trouble finding anything wrong with this account. Before I get started, if you're a beginner or new to Canadian finance, I've created a course for you called Canadian Finance Pro. Right now, it's 8 hours long, almost 60 videos where I discuss budgeting, credit, inflation, managing debt, tax, where to invest, and how to invest for beginners. I've recently increased the price of the course because now I'm offering a 1-hour one-on-one chat with every new member. This video is a snippet of what I'd include in the course. I'll leave a link if you're interested. As of the making of this video, I don't think the big 6 banks have an FHSA ready for you to open. It's so weird. They're a little late on the ball or late on the drop, but I think only Questrade is ready. You can see in the snippet, you can open one right away. Regardless, here are the details. There's a lot of nuance, and I mentioned it's a mix of the RSP and TFSA. To open an account, you have to be a Canadian resident and at least 18 years old or 19 depending on the age of majority in your province, and have not owned a home in the last 4 years. Like the TFSA, every Canadian gets the same annual amount. Annual contributions are capped at $8,000 per year, up to a maximum of $40,000 for the life of the account. So 5 years if you contribute the max every year. When you open an account, it can only stay open for 15 years or the year where you turn 71, whichever comes earlier. If you want to time it perfectly, the minimum annual amount you can contribute is $2,666 to get to the cap of $40,000 over 15 years. What's good? The huge benefit is the contributions are tax deductible like the RRSP. Any deductions can be used to reduce your income taxes. An easy way to think of it is like this. If you earn $80,000 per year and your current tax bracket is 35%, if you contribute $10,000 to the FHSA, it'll reduce your income by $10,000, indirectly saving you $3,500. However, unlike the RSP or HBP, the funds do not to be repaid back. When you contribute to an RSP, you get to withdraw up to $35,000 under the Home Buyer's Plan to buy a home. The catch is you need to repay the $35K over 15 years or get taxed on the amount you didn't claim. It's a slight drawback of the RSP, so you see the huge benefit and perk the FHSA get. You don't have to repay the $40,000 back. It's huge. I mentioned earlier, it can only stay open for 15 years or the year you turn 71. So what happens if you don't buy a home within the 15 years? You'll be forced to make a full withdrawal of the FHSA, and you'll be taxed on the withdrawal. You'll be taxed on the full account. Everyone would use this as a tax loophole. If you would open it, don't purchase a home. So if you try that, you'll be taxed. I haven't decided if the tax deferral is worth it, but I'll need to run the numbers if you decide to open it and not buy a home. However, contrary to whatever I just said, if you don't buy a home, you have the option to transfer the full balance to an RSP or RRIF if you're over 71. You won't have to pay tax on the withdrawal or the transfer. It's a tax deferred basis, meaning you'll eventually pay tax if you ultimately retire and withdraw from an RSP or RRIF, which is standard. You'll always be taxed on those withdrawals anyway. Another nuance to this account, if you buy a house, it has to be your principal residence. You can't use this account to buy a rental or an investment property. Another nuance, in order for this to work, you'll have to buy a house by October 1st of the following year. I'm thinking of the timing. If you withdraw your full $40K by Jan 1, 2023, theoretically you have until October 1st of 2024 to have a new home in your name to use the account. If you overcontribute, if you put more than $8,000 a year or $40,000 in your lifetime, you'll be taxed 1% per month on the excess until you withdraw, which is painful, so track it carefully. Okay, more details. Contributions are only deductible in the year you contribute. Just like the TFSA, it works on the calendar year. It's unlike the RRSP, where you can make contributions in the 60 days after year end. So January and February, you can carry it back, but that's RRSP only. You can have multiple FHSAs if you want, but every person has an annual and lifetime limit across all accounts. It's not per account. You can have 8 FHSA accounts if you want and contribute $1,000 each. I'm not sure why you do that, but it's just an option if you'd like. An interesting point, you can transfer your RSP to your FHSA. However, you can't deduct that transfer. You've already received a deduction when you initially contributed to your RSP, so you can't double dip, which makes sense. You can transfer the annual limit of $8,000 from your RSP to FHSA, but there's no tax deduction. Also, it only applies to your first home. This doesn't mean what you think it means. A first home means you didn't own a home in the last 4 years. It doesn't mean owning a home ever. So if you've owned a home 10 years ago, sold it, and you've rented ever since, and now you want to buy a residence again, you fall under the first home category. First home doesn't mean your actual first home, it just means within a certain time period. And that time period is this year and the last 4 years. We're almost at the end. You can use both the HBP and the FHSA on your purchase. Just because you used one doesn't mean you can't use the other. You can use both. So maybe a total of $75K to put towards a purchase if you're able to do it properly. Hopefully your investments would have grown in the first home savings account and you can withdraw more, obviously. And if you're buying with a spouse, you can each do $75K for a potential of $150,000 on tax deferred or tax-free deposit or down payment. Keep in mind, the FHSA is not a loan. You don't need to pay it back, but the HBP is a loan. You have to repay it back over the 15 years. So keep that in mind when if you're withdrawing both to buy a house. I know it gets a little confusing, a little complicated. Just know this isn't just an account. It doesn't automatically make you money. You have to decide what to do with the money in that account. You can use it to invest. You can do stocks, bonds, ETFs, GICs, or just keep it as cash if you're super risk averse. But I would advise to never just do cash. At least do a short-term or cashable GIC just to make some money instead of your cash just sitting there and losing to inflation. The best part, and this gets confusing, I actually shouldn't have left this to the end. Actually, there's no limit on how much you can withdraw. If you invest in stocks and it goes from 40K to 400K, that's your tax-free money for a house only. The home buyer's plan, you can only withdraw $35,000, but the first home savings account, you can only deposit $40,000, meaning your withdrawals are technically unlimited. At least that's how I understand it. The point is you can deposit $40,000 and then that is meant to invest and to grow. So if it grows from 40 to 400K, you can withdraw that out and use it towards a home. Last point, lastly, not as important, but it's also free RRSP room. You can open one, contribute, and you're allowed to transfer it to your RRSP even if you've maxed out your RRSP room. This is a little boost, which is nice. That's it for this video. A lot of small points to consider. Let me know if you have any questions. Thanks for watching and tune into the next one.